Hello everybody, what's going on? The latest report from CMB International has cast some serious doubts on NIO's short-term target. They are maintaining a hold rating, but they have lowered their target, suggesting the Q4 break-even goal simply won't happen. But why they are saying it? It all comes down to CG and A, that selling general and administrative expenses. The analyst team specifically stated that the absolute value of selling and administrative expenses are proving difficult to contain at third quarter levels. They believe NIO will post a net loss of around RMB 1.6 billion in the fourth quarter. While NIO is making huge stride in cutting R&D cost, we saw a massive 28% drop year over year in third quarter. The high cost of selling the car, running their luxury showrooms, and expanding their network is just too high to overcome by the end of this year. This news neutrally caused a wobble effect in the stock. The market loved short-term profitability. However, the bears are missing the bigger picture here. For the long-term investor, this short-term noise is a massive buying opportunity, I would say. We have to ask yourself, are these expenses a problem or an investment? I would say that this company is not struggling with demand. This is a company aggressively investing for a massive future scale. First, they are spending on their ecosystem moat. No other automaker in China or globally is building this kind of infrastructure. NIO is. Every dollar spent on swap stations, which now numbers in thousands, is SG&A expenses right now, but it's creating a competitive moat. Battery swapping is a massive differentiator, reducing battery anxiety, enabling service as a product, and creating a loyal city user base. You pay a high operating cost now to own the entire EV experience later. Second, they are spending on their multi-brand strategy. The market is focused on today, SG&A, but that money is funding tomorrow's profit engine. NIO is rolling out 5 new large vehicle models next year, and they are rapidly scaling two sub-brands, Onvo and the Firefly. These are designed to target the high volume mass market segment. You cannot launch 3 different car brands, build out the corresponding sales and service network, and not have high administrative expenses. These costs are necessary rocket fuel to capture the market share from competitors like Tesla and BYD. To me, the path from here is clear. Look at the numbers that aren't getting headlines. In third quarter, NIO reduces its net losses by 31%. The company is already demonstrating fierce cost control where it matters, like R&D. The fact that an analyst is projecting a smaller loss for the fourth quarter than third quarter shows the trajectory is undeniably positive. If they miss fourth quarter break even, they miss it by a little bit. But they are still marching towards their goal of the full year break even in 2026. So here's the bottom line. Short term skepticism is fine, but it misses the entire point of a high growth innovative tech stock. NIO, it is not just selling cars, they are building an EV ecosystem that takes heavy investment. The market is making the cost of building the factory, the PSS networks, the sub-brands, the R&D for an operational flaw. Here, I would say that it is the cost of dominance. For the investors with 3 to 5 year horizon, NIO's short-term dip fueled by skepticism over expenses that are actually funding massive future growth is an opportunity. So keep your eyes on the innovation, the infrastructure, and the market share.